Welcome everybody to today's webinar, why you should choose a self-directed solo 401k if you're self-employed. The truth is it's not fully accurate because you could be, we'll learn later about the qualifications, you could be employed fully somewhere else and you just need some self-employment income on the side, but I'm jumping way ahead of myself. My name is Jeff Astor. I pressed the wrong button. My name is Jeff Astor. I work for Broad Financial. We'll learn about that too. But today's webinar is going to be a short overview of what a solo 401k is, a self-directed solo 401k. And then we're going to open up to live questions and answers afterwards. That's usually the most lively part. That's the main goal. We do have a lot of information on our website. I'm going to tell you about my book. We can read more about that also. So we have a lot of information, a lot of good educational stuff in terms of reading material, previous webinars, all different videos, all these types of things. So we're going to leave a lot of the heavy load of education about what a solo 401k is to that. But I'm going to give you a brief overview and then I'm going to go right to the Q&A. So without further ado, what's the purpose of a solo 401k? What's the purpose of a self-directed plan? This is what we do at Broad Financial. We do self-directed plans and only self-directed plans. Self-directed means the ability to take your retirement money out of Wall Street, not necessarily exclusively, most of our clients have a mixture, but take it out of stocks, bonds, and mutual funds, which you know as the market goes, when it goes up, everything goes up. When it goes down, everything goes down. But take it out of there and put it into what's called alternative investments. That means things that are not offered in your typical stocks, in your typical Fidelity, Schwab, TD Ameritrade, whatever it is, as wonderful as they are. You can't buy real estate with them. You can't buy precious metals, cryptocurrencies. You can't make hard money loans. We'll get into all these different types of things that you can do with it. Self-directed in our world means, in the broadest sense of the word, the ability to go off of Wall Street. And nearly that's what we're offering here in our plans. And a self-directed plan in particular allows you to take full control of the retirement account. You can have some in Wall Street, you come in some in a self-directed plan, then you can invest it where you want, when you want, with low predictable fees. And with Broad Financial, you get great support. We'll talk more about that also. Don't take my word for it. I always ask people to do the research. But that's what a self-directed plan is about. We've had a lot of webinars to this date on the self-directed IRA. Today we have a self-directed solo 401k. And we're going to talk about it. So first, who's Broad Financial? Broad Financial, we've been around, we'll talk about it 10 years. But about 10 years ago, when the market crashed, 2008, 2009, one of the owners of this company, his parent lost about 40% in his retirement portfolio. And the owner asked himself, why is Dad invested in Wall Street? We know all about real estate because Broad Financial has been around since 2004 and the owners have been involved in real estate. Why is Dad invested in Wall Street? Let's get him invested in real estate. We have better control and better knowledge of how to make money, how to prevent problems, when problems do arise. And so they discovered this plan for his father, and then they did it for some friends and then family, and expanded to, by 2009, they realized they had a business that they can offer others. And so since 2009, we've been offering these plans. That makes about 10 years in the business. We have 10,000 plus clients. A+ customer support, that's the most underrated feature you can search for if you're comparing companies. So customer support could be the difference between really life and death of your retirement money. Because if you don't get the right answer when you need it, or you get the wrong answer, or there's just no one around, you could be making a decision that could cost you thousands, tens of thousands, hundreds of thousands of dollars in IRS penalties and taxes if you don't get the right advice. So you need a great plan, and B, even more so, a great company. And again, don't take my word for it. You go around the internet, you search Broad Financial reviews. It's not just the A+ on the Better Business Bureau. It's not just the nearly 5.0 on Google and all that. It's actual testimonials from hundreds of people, of our clients over the past 10 years that can say, wow, this is a company that really emphasizes customer support. Very important thing, especially in the 401k world. The 401k world is littered with fly-by-night companies that come up one year and gone the next year. We're going to inevitably get a call next year from people that have signed up with a cheap plan and they can't get through the guy. Maybe the guy was in his pajamas when he spoke to them. You don't know with these fly-by-night companies. They don't have a record on the Better Business Bureau. They don't have a good record if they do, and that's why a company is so important. So Broad Financial, besides the fact that 10 years of 10,000 plus clients with great reviews, we have a sister company called Madison Trust. Madison Trust, what we're going to talk today about are checkbook plans. The checkbook plan gives you the ability to take your money out of a custodian, out of a third party's hands, and into your own hands, and put it at a bank of your choice. Those are called checkbook plans. But we also have a custodian, a sister company called Madison Trust, and they're perfect for certain, like a one-time lump sum investment type of investment. Real estate, you'll see, is a checkbook plan. But a one-time investment, you got Madison Trust. That's our sister company. That number's a little old, 1.5 billion. It's now about 2 billion. I think it's over 2 billion in assets. So that's a federally regulated company with a lot of people's monies that they're holding, within the structure of federal regulations. All these things tell you we've been around a long time. We got a great track record. We've got lots of clients, and we got a very stable, financial records to prove, not just my work. That's all out there. That's Broad Financial. Now, who am I? So I am Jeff Astor, that's me, and I am the author of this book, The Ultimate Self-Directed IRA. And as the subtitle says, it's not only all about self-directed IRAs, it's done in plain English. It looks like a thin book, and it is. It's meant to be that way. In 2 hours or less, you can read this book. We have an audio version. These are available on Amazon. You have a softcover version like this and a Kindle. 2 hours or less, you'll be in the 95th percentile of knowledge about these things. Very quick read. People tell me it's an enjoyable read. You can even call us up and we can send out a free copy to you if you want, but it's available there on Amazon. So I'm the author of this book. I've been working here at Broad Financial 7 years. A couple years ago, people started asking me, Jeff, you explained it great. What else can I do? What am I not asking? I said, well, I didn't really know what to say. So I thought to myself, let me write the book. So I took a weekend, I pounded a few hours out, and I got the basics of the book. We passed it around the office, and we got it all honed in and checked and double checked and triple checked, and finally the book came out. Now when people ask me, Jeff, great explanation, what don't I know? I said, well, I don't know what you don't know, but I do know that if you read this book, I'll know what you know. And from there, we can go on with a lot of questions. So this book has been a great boon to helping us educate and explain this to people. And I encourage you, if you're interested, if you haven't gotten it yet, go on Amazon, ask us for it. But that's who I am, and that this is a product of being here in Broad Financial and working 7 years in this industry. Basically, over the 7 years, I sit at my desk and I either talk to people or email people about these plans. It's now over 20,000 contacts. So this is my bread and butter, and it's sort of distilled into a really nice, easy to read, book in 2 hours or less. There's another picture of the book. Okay, even a close-up. Using the self-directed IRAs and solo 401ks. There's a chapter in here in solos, which we're talking about today, and it's all in plain English. I'm very proud that it's in plain English. Now, what is a self-directed solo 401k? Basically, it allows people with self-employment income to invest in all these types of alternative investments, as I said, real estate, cryptocurrencies, startup companies, notes, loans. One of the chapters in the book talks about exotics. I love the chapter on exotics. These are the things that you would never thought that you could invest in with an IRA. But the IRS says you can invest with a solo 401k in everything but collectibles. Collectibles are like artwork and coins before 1933 that are based on the values based on antiquity. Baseball cards, those types of things. Those are off limits. Everything else is in play though. With the caveat that you can't self-deal. You can't buy a property you already own. We can talk more about that. You can ask your questions about that. But a solo 401k gives you, and the self-directed solo 401k gives you the ability to invest in all these things. The vast majority of our 10,000 plus clients are, in fact, investing in real estate. We have a lot of experience with that, and we're happy to guide you with that. We're not going to give you investment advice. We are going to give you all the legal advice that you might need to make sure you stay within the rules, to educate you the rules, and to call and have live support to talk to people in your specific situation. Now, who qualifies? Now, in an IRA, everybody qualifies for an IRA. You just have to have some retirement money or be able to contribute new retirement money. But in a solo 401k, you have to qualify. And as I said earlier, you don't have to be fully self-employed, but you have to have at least some self-employment income. That means money coming in from an LLC, an S Corp, or surprisingly, to most people, you can be a sole proprietor. Sole proprietor means you're making money, they're writing a check out to you, and it's not an LLC, not an S Corp, but you're declaring it on Schedule C of your income. If you have rental income, that's Schedule E, that's passive income. Schedule C is active income. Many people calling this up, they have the rental income, and they feel, bummed out that they can't get the solo, but they can, because you can, as we talk, in many cases, they can easily recharacterize some of their activities as actual management. Like, for instance, even depositing checks, rental checks is an active activity. We always recommend that they talk to their accountant to confirm. But basically, it's, if you have rental income, and even if you've been declaring on Schedule E now, it's probably pretty easy to put on Schedule C. If you're making 500 or more of that on Schedule C, you can take that 500, make a yearly contribution, the necessary required minimum yearly contribution into a solo, and you're in play now for the solo. As long as, click point number 2, bullet point number 2, you don't have any full-time W-2 employees. Full-time is 1,000 hours or more per year. If you have even one of them and one of several businesses that you have, that would disqualify. But if you have none, or if you have one and you own less than 80% of the business, then you do qualify. I'm talking fast. This is in the book. You call us if you have any questions. But basically, minimum self-employment income, no full-time employees, and you're in with a solo 401k. The solo, by the way, the minimum is you have to make a minimum contribution of 500 per year, but you have a maximum of 56,000 per year if you're under 50, and 62,000 if you're over 50. Now, there's a whole bunch of advantages for the solo over the IRA. I expect to get some questions, but besides the higher contribution ceiling, which in an IRA is either 6,000 under 50, 7,000 over 50, in the solo 401k, a husband and wife, if they're both self-employed or partners in an LLC or something like that, they can qualify for one single solo. 2 people have one solo 401k. If they didn't qualify, they'd need 2 IRAs, one for him and one for her. So lots of advantages, and it costs less to set up and less to maintain. Wonderful plan. I have one of these myself. It's just one of the great secrets out there. You can do a lot of this. You can go on Wall Street with it. You can go off Wall Street with it. Unbelievable plan. Great company, brought financial backing you up. So, please take advantage. Give us a call if you have questions. Read the book and call us in. I just want to give you a couple examples of how people are using this. And as I said, people are using this for lots of different things. I talked about the exotic. So an exotic is the ability, someone took our plan and is using it to invest in an Arabian racehorse. Who would have thought of that? It was my guy, as a matter of fact, and I got an education in Arabian racehorses, how they're big risk but high reward. But you could use it, not a problem. It's not a collectible. I guess not. I guess if it's a dead horse, maybe it would be. But no, you can buy Arabian racehorses, treasure chests. I had a guy, did a treasure island, invested in. But those are the exotics. The most common story is real estate. And a very common call that we get from people was the person, couple calls up and said, listen, we found this wonderful beachfront or lakefront property, and we'd love to live in it in retirement, but we're not there yet. We don't really have a lot of cash, but we do have a lot of money in our retirement plan. And we'd love to be able to buy the property, collect rent, watch it go up in value over the years, and then live in it. And that's a common question. So that, in fact, is a lot of things we were able to help a lot of people with. Because even though one of the rules is that once you buy a property with your 401k, you can't live in it, you can't make personal use of it. But after X amount of time, whether it's a year, 5 years, 10 years, you want to live in it, you can declare the property value, the value of that property as a distribution. If the property is worth $100,000, it's like you treat it like $100,000 in cash. You pay your taxes on it. That's called a distribution, whether it's 10%, 20%, 30%, whatever the tax bracket would be. You'll need an accountant to figure that out. But basically, whatever it is, you pay the taxes on it. And now that property leaves the realm of a retirement 401k property into a personal property, which now you can live in. And while it's still in the property under the jurisdiction of the 401k, you cannot live in it. You can collect rent. You can make a lot of money off of it, but you can't personally make use of it. But you can, again, take out the distribution, and that's one of the nice success stories that we have, and we've had this several times. People working with people to do that. Another story is this was a young woman who was making quite a bit of money buying property. She bought a property, if I recall correctly, in a college town, and she was thrilled because she was charging, significant rent, and the kids' parents were paying for it. The parents built that into their tuition. How to pay for the kids' dorm, and that was basically an off-campus apartment. And she had enough money to buy one, but then she wanted to buy another one. A great opportunity came along, and she didn't have enough money. But she realized that she does have some money in her retirement plan, and she was self-employed, and even if she wasn't self-employed, if she had an IRA, she could do the same thing. But she had money. She called me up and we discussed this, and she was able to get her IRA, all her 401k money set up. And lo and behold, she went in and bought the property and doing quite well. There's a lot of stories like this. I have a bunch in the book. These are just the real estate stories. We have lots of different types of stories. Cryptocurrencies, it's in the down now. Maybe it's the time to buy, but we've got people done quite a bit. They've made 1,000% gains in a year. Using cryptocurrency is very risky, but a high reward also. Lots of different things to do. These are only a couple of really thousands of stories that we've had our clients talk to us about. Now, if you want to find out more, you can listen here and ask questions, or you can give us a call, or you can just call or just email us. You can set up a time. We have a calendar program. You want to call in and just ask for me or any of this. We've got a very competent sales staff. They can talk to you about anything that you'd like. And in fact, they are available now. We're here in the evening here we're open until 6 o'clock Eastern time. And feel free to give us a call now. There's your number, 800-395-5200. I'm not available now because I'm moving the webinar, but if you want to call in and ask for Jeff, you feel free to do so. If not, just call in. Lots of people here that can help you with questions and answers. That's the gist of it. That is the gist of what a solo 401k is. I went fast because, again, we have a lot of great information all over our website. We got the book, we got videos, and we're just growing with our educational resources as well. Look for more and more as we go on. And we encourage you to do the research and to do it. Now, assuming you've got the basics, self-employment income, no full-time employees, you got some retirement money, or you want to build up your retirement money, that's what a solo 401k is for. You hit the 56 to 62,000 per year. Even if you're starting with nothing, you can really build it up. And if you want to do that, it's a great opportunity. Again, give us a call. But now we're going to move on to the Q&A section, session here. And I believe my colleagues, Brian and Alex, have some questions that they're going to throw me. I haven't heard the questions. We're going to try and funnel in the solo 401k questions. And if we have time, we'll try and go into some self-directed general questions, whether it's a solo or 401k. But all right, guys, you there? Alex, Brian?
Hey, Jeff. Hello, everyone. Thank you
Alex,
for your questions. And first up, we have one from Luis, and he asks, can I roll over an IRA into a solo 401k?
Yes, Louis. Excellent question. So an IRA and 401k money is basically interchangeable. You can move an IRA into a 401k, now becomes a 401k, and then you can move it back into an IRA, becomes an IRA, with one exception, really two exceptions, one common exception. If you have a Roth IRA, a Roth means that you pay the taxes now, and your principal in your profit is tax-free, not just tax-deferred. If you have a Roth IRA, the IRS created a barrier, and you cannot move that into a solo 401k. Traditional IRA money, yes. Roth 401k money, yes. But Roth IRA money cannot go into the solo. The other exception is an inherited IRA. If you inherited an IRA from a parent, for instance, that can't go into a solo 401k either. But basically, most people don't have inherited IRAs or even Roth IRAs. And so if you have an IRA and you want to use that money to create a self-directed IRA, yes, you can move it into the solo. By the way, one thing I forgot to do here, as I brought along me here, this thick thing. See this? Nice and thick, lots of pages here. I'm not even sure how many pages here. This is what you get when you sign up with Broad Financial with a solo 401k. You get this binder, and it has in here some trust documents, which is good stuff. If you're very tired at night and you can fall asleep, you can read all the legalese about the trust documents. But it also has a lot of practical information in here, the do's and don'ts of solo 401ks, as well as common protocols and a whole bunch of very worthwhile things. So you get a quality. This is what you do when you sign up. You fill out the forms and send this out to you. It gives you a great inspiration about how to go when you go to a bank, and a cheat sheet. That's a very important thing. You know, a lot of times people in the early days, you know, a lot of other companies, they just throw things together. We work very hard at making a very comprehensive binder, including a cheat sheet for signing up at the bank. Because that's basically what you're going to do in a solo. We're going to create a trust. You're going to take the trust documents are going to be in here. You're going to take it to the bank. You're going to sit down and say, here's my documents. I want to open up a trust checking account. And then you have the receptacle. After that, you're going to fill out forms to roll your retirement money into there or make new contributions. And you're off to the races in terms of investing. But this is the core of what you get. the trust documents that you take to a bank of your choice. Money is rolled in there, and you're investing in a check, or what they call a checkbook controlled, self-directed plan. Okay, Alex, got another question coming.
Yes, I do. There is one from Roxanne, and she asks, is there a limitation to how many rollovers I can do in a year?
So that's a good, excellent question, Roxanne. A lot of people are confused because they've heard that you can only do one. You can only do, there's two types of rollovers, an indirect rollover and a direct rollover. In an indirect rollover, you as the individual tells the institution, please send me the money. That is called an indirect rollover. That you only do once a year. That you have 60 days to put in a retirement account, or else now it becomes taxed. But what we do as an institution, as a financial institution, we do what's called a direct rollover. That means we'll give you the forms and the information so that when you contact the information, the financial institution that has your money, you'll fill out the proper forms. And when they roll it into the trust account, into the 401k trust, it's a direct rollover. And direct rollovers that are non-taxable events, you're not limited to 60 days, and you can not limit it to once a year. You can do them again and again and again. And in the Broad Financial Plan, we have no transaction fees, we have no asset-based fees. You can roll money in and out of the 401k without paying a penny to us, just whatever electronic fees are involved with the bank. But we don't charge you anything for transactions, for rollovers. We just have a flat setup fee and a flat yearly fee for some maintenance that we have to do with support, but no transaction fees and no rollover.
Okay, great. Next, we have what looks like a three-part question from Sonny. And first he asks, if the LLC does not make any money and loses money, are there any issues with not contributing to the solo 401k?
Okay, let's take one at a time.
Sure. Yeah.
So that's an excellent common question. So the rule is that, as I said, you have to have a minimum of 500 per year. You have to take a minimum of $500 of your, here's the key word, net profit, and put it into the solo 401k as a year contribution, minimum. Obviously, 56 or 62,000 per year is the max, but 500 is your minimum. If you're not showing a profit, then that's not going to help you. Unless you have something like an S Corp, where in an S Corp you give yourself a salary. When you give yourself a salary, then the net profit limitation doesn't apply. If you're losing money, but you give yourself a salary, then that would suffice. But in most cases, like in an LLC where there is no W-2 option, basically, you have to show a net profit. And if you don't have the net profit, you don't qualify. On the other hand, once you started the plan, and if you have, the IRS does recognize that if you have a bad year as a self-employed person, and they recognize that you do have, so if you skip a year, you actually can, the following year, put in the minimum of $1,000, and that would cover you. So you could have a bad year where you don't make a net profit, but at least if you have 2 years in a row with no net profit, no ability to make contributions into the solo 401k, then you'll freeze your plan, whether you'll stop your activities, and whatever you have in there, you'll move it into a self-directed IRA. You don't lose what you have if you 2 years go by without self-employment income, but you'll be able to move it into an IRA. But again, if you don't have that net profit to begin with, then I'm afraid you can't sign up. The plan's not, if not for you, you don't qualify. Then we talk about a self-directed IRA. That's Sonny's first question. So here's another part to that question?
Yeah, the next two questions are pretty interrelated, so I'll just kind of ask them together. He's wondering if a solo 401k can invest in an LLC as a partner, and then he's also asking if he can be the manager of that LLC.
Yeah. So so there are a couple of, you could be asking in different ways, but I think what I might be asking is that what this chapter 12 of the book has a chapter called co-investing. Co-investing means, let's say you have a $100,000 property and you have $50,000 and you have a partner who has $50,000. Whether the partner has an IRA, a 401k, or just taxable funds, doesn't matter. You can co-invest with him. So you got the $50,000 of your 401k, $50,000 of his money. You put them together to get the $100,000 property. And typically, what you'll do in that situation is create what we call a sub LLC, which is a regular LLC that has two members. One will be your 401k, and one will be your partner, whether it's his 401k, his IRA, or his personal fund. So you will put that into the sub LLC. I think that's what Sonny's asking. And yes, in that sub LLC, Sonny, you can be the non-compensated manager. You can't be compensated for your work. You can be compensated in terms of profit that the LLC generates, but you can't be. You'll have to be the non-compensated manager. And that's basically also when we do an IRA, we create an LLC, an IRA LLC, and in that case, we designate the person a non-compensated non-compensated manager. So yes, you can manage the LLC, you can make the decisions where to invest it, you can pay the bills, you can collect the rent, all these managerial type functions. You can't do any manual labor, by the way. You can't pick up the nail and hammer, but you can hire the contractors, you can watch what they do, you can go and collect rent. Those are all managerial functions that you would be allowed. In the general sense, if you have any particular, you can ask us, but generally speaking, yes, you can be a non-compensated manager in these cases.
Great, Sunny. Hope you are satisfied. Okay,
Okay.
next is from Roger, and he asks, can a partnership interest be transferred into a solo 401k from another self-directed IRA?
Yeah, I guess what he's saying is if he and a partner have an IRAs, can they become partners in the solo 401k? And if they both qualify, the answer is probably yes. But I would suggest calling us up and talking to one of the reps here to hear the specific situation. There could be some things that could make that a problem. The general rule is though, yeah, you can if you qualify for the solo, partners can come in and partner into one solo.
Okay, so next is a question from an anonymous attendee,
Uh-oh.
and he or she would like to know, would it be true that no taxes need to be paid from income going into an IRA as long as that income stays in the IRA until you start drawing it out after retirement?
Right, that's the idea of an IRA or a 401k is that your money, while it's in here, is tax sheltered. So you could spin off a lot of profits. You could buy and sell, you could have taken a lot of rent, and you're not paying taxes until either you hit 70 and a half when you're required to take out a minimum amount, or you voluntarily take it out before 70 and a half. Yes, that's the idea of an IRA. Your profits come back tax deferred or tax sheltered, until you hit 70 and a half.
Okay, great. Next, we have a question from Freddie, who
Great.
asks, who sets the interest rate if you take out a loan for the 401k?
So well, we didn't mention that one of the real nice advantages of a solo 401k that you don't have in an IRA is a personal loan feature. I'm not talking about making investment loans. You can make an investment. You can lend a person a bridge loan to somebody, give them X amount of dollars and take back interest. That's a nice way to make an investment. You can do that in an IRA or 401k, but the solo has a personal loan feature where you can take out 50% of what's in there, cap off at 50,000, and then use it for anything that you want. You can use it for your own business. You could pay off big credit cards, mortgage. You could blow it in Vegas if you want. Not recommended, but you could if you wanted to, as long as you pay it back. And you do have to pay it back. You have 5 years to pay it back. You pay it back quarterly every 3 months. So over 5 years, that's 20 payments. Got to be 20 equal payments. And yes, you do pay interest. The interest, so it's like a real loan, but the interest goes to yourself. It's really the best type of loan. You're paying yourself interest. And the rate, yes, is around the prime. Maybe a half a point this way, a half a point that way, but it's got to be around the prime rate so it's like a real loan. So yes, Freddie, you could take the loan, you do pay the interest, and the interest to yourself, and it's around the prime. Next.
Okay, next. This one's from Greg, and he asks, do I have to roll over all the money in my current 401k to sign up with Bro Financial?
Nope, that's the good news, Greg. You don't have to roll it over. You can keep whatever you want. Most of our clients, I think, have some money in the market, for instance, and they're using their money that they want to use to buy a house or invest in cryptos, whatever it may be. They're just moving in what they need into our plan. So you could keep some there and move some here, and it's very fluid. You can move, if you do your investments here and you want to move it back into the market, you can do that. If you want to add more money from your bank or from your market, or more retirement money and put it into the solo, you can do it. And in the solo, there's no rollover fees, no contribution fees. There's some paperwork, your forms you fill out. Well, that's in the binder here, and we'll help you with that. But in fact, you don't pay anything for that, and you're totally free to do it as often or as infrequently or frequently as you prefer.
Okay, Sonny is following up. Yeah, Sonny, yeah, he's very, very curious. And he just wants for more clarification. When he would start an LLC, it's a startup, and if it does not make money for the first year and he contributes next year at least 1,000, he should be okay, correct?
Yeah, call us for the specifics of the situation. In general, that's probably doable. but call us for specifics. He's asking if you didn't have it to begin with. Well, it could be a little tricky in some areas, so that's why we're asking you to call in and ask and deal with our specifics. Certainly, if you only have 500 in one year and then the next year you can't do it, then the following you do 1,000, that's the ideal situation. To do it in a way that Sonny seems to be suggesting that he doesn't have anything, but he's sure he's going to have it the next year. They could just be a little tricky if you started up and you never made the solo 401k, you never made the qualify for the solo. If the IRS looked at that, in theory, they could make a problem about that. So we wouldn't recommend that necessarily, but you talk to us and we can, hammer it out and see if there's a realistic way, how to overcome it. I mean, the truth is that in the end, you only have to put in 500 per year if you're net profit. And we've had people, I talked to one lady about sewing sweaters, walking dogs, mowing the lawn. One fellow went back to his old business partner and we did some consulting work. So all these are ways to make your 500 per year. And hopefully, if in fact you have a tough year, or if you want to get off the ground, we recommend that you actually do it in the beginning. There may be some exceptions of otherwise.
Okay, great. So next is a question from Jacob.
Jacob.
And he asks, who serves as the custodian for the 401k?
Great question, Jacob. Great news. There is no custodian in a solo 401k. The custodian is only in an IRA. An IRA custodian, every IRA needs a custodian. We didn't discuss this here, but we have in the custodial self-directed IRA, the custodian holds money. In the checkbook self-directed IRA, the custodian merely moves your money, and then they report to the IRS. That's reporting, either holding it and reporting or moving it and reporting. That's in an IRA. In a 401k, there's no custodian at all. So our sister company, Madison Trust, is not involved. You, the 401k holder or owner, is their own plan administrator. So you'll make all the decisions and all about, taxes and investments and all that, and we'll guide you. That's part of what the finder is about, to help you guide you. But there's no custodian in a solo 401k.
Okay, thank you. Next is a question from Barbara, and she said that she saw somewhere that December 31st is the deadline to contribute for 2019. Is that correct?
Should have mentioned that from the beginning. Yes. So an IRA, the year IRA goes from April 15th to April 15th, but in the 401k, it's January solo. It's a 401. It's January 1st to December 31st. What that means is that you have to sign up for the solo by December 31st. If you want to, we're in 2019 now, soon to become 2020. This applies to any year, but if you want to sign up and put 2019 contributions in here, you have to sign up by 2019 to be able to do it. After December 31st, you turn into a pumpkin and you can't do it. There are potential ways that you can talk to us about backdoor ways. Even if you did miss the the December 31st cut deadline, we do have some backdoor ways in which you can sign up for a solo, let's say next year in January, February, there's a way you can make a 2019 contribution and roll it into the solo, but that's really not ideal, and it's perfectly legal, but basically you want to sign up for the solo by December 31st, and then you have a little bit of time to make your contributions. There's two types of contributions: a salary and profit. You'll ask us for details. You have the salary portion of your contributions you have to make pretty quickly, but the profit sharing portions you have more time. But the bottom line is you can't make any of those 2019 contributions under normal circumstances if you don't sign up by December 31st. So that is an important date in the 401k world. Wait, is this how I really look? I didn't know that's how I really look. This is very strange. Okay. Anyway.
That's all you, Jeff.
No, okay. No Super Bowl question? Last time we had a question about Super Bowl tickets.
Yeah, he must have.
Yeah, I don't know. Okay.
He must have bought the tickets. Okay, next is from another anonymous attendee. I suppose it could be the same one from the last question. I guess we'll never know. Okay. So this attendee asks, some real estate investments and rentals will have an annual yield and a sale after so many years, which would have an IRR. Are those IRR taxes not applied if the money stays in the IRA?
Well, truth be told, I'm not sure what an IRR is, but if it's a profit, Yeah, well, you take any profit, whether you make it from a sale, whether you make it from rents, and you put it right back into the solo, and that keeps it sheltered from taxes. Any profit. One of the things people don't know is that inside an IRA or a 401k, there's no such thing as capital gains. When you take out a distribution, whether it's voluntarily or by 70.5, that distribution is considered income. So it's added to your income for that year, and that may raise your income bracket at all, at the time. But whatever profits were gained or lost in between, irrelevant to your distribution. It's just a flat figure, and it adds to your income. So I'm not sure if I understand the situation that well, but again, any profit that's made inside an IRA or 401k, there's no capital gains, and you just take the profit and put it right back in the plan, and it stays sheltered from tax.
So IRR is internal rate of return. It represents the percentage rate earned on each dollar invested for each period it is invested.
Okay, so I mean that sounds like you worry about capital gains, because that would be a case if it's a non-IRA, non-retirement plan. That's my understanding of it. If he's otherwise, he can come back, ask the question, and call in. But again, if it's something related to a capital gains fear, you don't have to worry about that inside a 401k or IRA.
Okay, great. So next question is from Roger. He's back with another one.
Roger.
And he asks.
Do you charge for the second question? We don't charge for the second round?
Roger asks, how are UBIT and UDFI treated in a solo 401k?
Right. So, again, we try to stay basic here. They do have a chapter here on UBIT and UDFI. By the way, here's the table of contents. You can see it on Amazon. I don't know if you can see that. But anyway, UBIT stands for Unrelated Business Income Tax. Sometimes it's UBTI, UBIT. And UDFI, as Unrelated Debt Finance Income, is a subset of it. So I don't want to go into too much detail about that. A UBIT means, in generally, that if a person does their activities in an active way, meaning, for instance, flipping houses in a frequent way. That's the IRS uses the word frequent. It's frequent twice a year. It's frequent 3 or 4 times a year. You can debate that. I've had people debate that. But if you're doing an active business, you're using your IRA to buy an eBay business, buying and selling all the time. An active business could trigger and would trigger, if it is considered active, UBIT, Unrelated Business Income Tax. It's a tax, even though you're inside an IRA or 401k, and it could be a painful tax. Then there's something called UDFI, which has to do with using a loan. One of the rules, again, I'm being very superficial and quick here. One of the rules in an IRA or 401k is that when you can't get a regular loan. You can only get what's called a non-recourse loan. Non-recourse loan means the lender has no recourse to your personal assets should you default. They can come after the property that's collateralized inside the 401k or IRA, but they can't come after you personally. Most banks don't like that. It's harder to get a non-recourse loan. If you do get that loan, and maybe 5% of our clients are using our plans with financing. It's not common, and we do have some good lenders that have helped our clients in the past. But if you do get that loan, you're in an IRA, but not a 401k. In an IRA, you're subject to this unrelated debt finance income, which again is a tax that, even though it's a tax on the loan portion. If you have a $100,000 property and the 50 was the IRA and 50 was the loan, so the profit that's generated off the $50,000 loan is subject to this UDFI. That's only in an IRA. It's not true in a 401k. That's one of the dozen advantages of the solo 401k, is that even if you took out a loan, if you got the loan, you got the non-recourse loan, but you don't have to pay UDFI. There's no UDFI in a solo 401k. So that's one of the big advantages. And if people, when they hear about this, but there's another reason why they love the solo 401k.
Okay, everyone, we are getting towards the end of this Q&A, this webinar. So we have time for one more question, and that is from Tamara, and she asks, are in-laws considered disqualified persons?
Excellent. So what's a disqualified person? Disqualified person is people you can't interact with your IRA. It's considered self-dealing. So you can't buy a property that you own. You're disqualified to yourself. Your spouse is disqualified. You can't buy the house from your spouse or buy the IRA the plan, buy the house and have the spouse live in it. That's disqualified. Disqualified also includes lineal ancestors and descendants. That means parents and grandparents, children and grandchildren. Surprisingly, to the side, brothers and sisters are fine. They're not disqualified. Aunts and uncles, nieces and nephews, cousins are all in play. The question is in-laws. Now, downward, sons-in-laws and daughter-in-laws are disqualified. You cannot I've had this very often. Person wants to use an IRA to buy up a house for his son-in-law, daughter-in-law. Not good. Not allowed. Prohibited. Transaction. Upward, you can't buy your house from your parent, your mother or father, but you actually could buy it from your mother-in-law or father-in-law. It's a funny rule. If you're not sure, ask us about it. So in-laws down, sons-in-laws, daughter-in-laws are off limits. Going up, there is an exception where you could possibly, if it's only you and it's only your in-laws, your mother-in-law, father-in-law, then that probably will work. But again, call us if you have any specific questions. With the specifics, I really suggest you call us. We'll hear it out. There may be some exceptions that you're not aware of, but that's the general rule. And I think that brings us up to closing.
That is correct, Jeff. Thank you to everyone for joining, and thank you for your great questions. I hope you
Are we
enjoyed.
gonna answer if there are questions that weren't answered? Are we gonna? So we have some questions that weren't answered because we're happy to still send out answers to the people. We'll email them or have them call in. But if there are questions that weren't answered, we'll take care of them. But again, always call. You got the number there, 800-395-5200. Call us up. This is what we do all day. We talk to people about self-directed IRAs and 401ks, and if we can't give you an answer on the spot, we'll get back to you. And same thing, you know, once you're on board, we've got great education, great answers, and really encourage you to give us a call.
And I said it better myself. Thank you, everyone, and have a great night.